Moral hazards. Moral hazard is a concept in economics and risk management that describes how an individual or business's behavior may change once they become insured against the risk of a certain action. It occurs when people take unnecessary risks because they know they will not bear the full consequences of their actions. In other words, moral hazard exists when someone has little incentive to behave responsibly due to the assurance of protection against any losses caused by their actions. For example, if you have not insured your house from any future damages, it implies that a loss will be completely borne by you at the time of a mishappening like fire or burglary. Hence, you will show extra care and attentiveness. You will install high-tech burglar alarms and hire watchmen to avoid any unforeseen event. But if your house is insured for its full value, then if anything happens, you do not really lose anything. Therefore, you have less incentive to protect against any mishappening. In this case, the insurance firm bears the losses and the problem of moral hazard arises. Similarly, banks and lenders may be more willing to provide loans if they know that the government or other entity will provide a safety net for them if the loan goes bad. Moral hazards are also called principal-agent problem. In the insurance context, the insurance company is the principal, and the policyholder is the agent. Situations like moral hazards are bad for the economy as it can lead to market failures. Thus, there is a need to follow steps to mitigate the risks of moral hazards. So, what can a principal do to face the potential moral hazards? One possible solution could be an improved monitoring of agents' action by the principal, but the marginal benefit of this improved monitoring should be weighted against the marginal costs associated with it. Regulations should be introduced by government, and some basic requirement guidelines should be introduced by insurance companies, which clearly specify the actions to be taken to reduce moral hazards. Insurance deductibles and co-payments should be imposed by the insurance companies. Such provisions in insurance contracts that impose costs on the policyholders for behaving in a risky manner will reduce their willingness of taking any risk. So this was a brief video about moral hazards, how it can impact economy, and how it can be mitigated. To stay updated with more videos, do subscribe the channel and like the video. Thank you.